Want to turn your screen time into serious cash? Heard about stock market trading but unsure where to start? Stick around. Welcome to your channel name, the place where money making is our game. In today's video, we'll be delving into the thrilling world of stock market trading and investments, a powerful avenue to accumulate wealth online. We'll simplify complex concepts, explore smart strategies, and even reveal some trade secrets that top investors use to rake in those big bucks. And you'll want to stay tuned until the very end because I'll be sharing some exclusive tips on how to spot a winning stock from a dud, which could potentially save or earn you thousands. This is real, actionable advice that you can start using today to transform your financial future. Let's dive in. Educate yourself. Understand the basics of stocks, economics, and financial reports. Diving into stocks, economics, and financial reports could be intimidating for many, but gaining a basic understanding is crucial for making informed financial decisions. Stocks. A stock represents partial ownership or equity in a company. Each share of stock signifies a fractional stake of the operation and profits in the company. The more shares an investor owns, the larger their interest in the business. Stocks are mainly categorized into common and preferred stocks, with varying levels of risk and reward. Prices of stocks fluctuate based on supply and demand, driven primarily by the company's earnings. If a company's profit increases, the demand for its shares tends to rise, applying an upward pressure to its prices, and vice versa. Economics. The backbone of all investment decisions lies in the fundamentals of economics. It provides tools to make sense of the complex dynamics of financial markets. Economics pertains to the production, distribution, and consumption of goods and services. A firm grasp of concepts such as inflation, economic cycles, fiscal policy, and monetary policy help in understanding the broader economic environment which directly impacts stock prices. Macroeconomic indicators such as GDP growth, interest rates, and employment data can provide insights into the direction of the economy, thereby offering a clue as to which sectors and companies might prosper. Financial reports. Financial reports are the pulse checkers of any company. They are mandated by regulatory authorities and provide transparency into a company's operations. Financial reports encompass a balance sheet that provides a snapshot of a company's assets, liabilities, and shareholders' equity at a given time. The income statement shows revenues, costs, and profits over a reporting period. The cash flow statement demonstrates how much cash a company generates and spends during a particular period. Reading financial reports gives investors insight into a company's profitability, financial health, and future prospects. Educating yourself in these areas provides a solid foundation on which to build your investing prowess. Continuous learning is critical as financial markets are dynamic and multifaceted. The more knowledge you gain, the better positioned you are to navigate financial markets and make sound investment decisions. Having a good understanding of these areas will help you avoid common pitfalls and maximize your returns. Whether you're interested in personal finance, investing, or entrepreneurship, understanding these fundamental concepts is a crucial first step in your financial education journey. Set up a trading account. Choose an online stockbroker, and open a trading account. Setting up a trading account is essential for individuals looking to invest in stocks, bonds, or other types of securities. With a trading account, investors can deposit money and buy or sell investments according to their financial plan. It's an important part of managing one's investments, and choosing the right online stockbroker essentially impacts how successfully one can trade. Choosing an online stockbroker. The choice of the online broker is one of the most critical decisions you will make. Online brokers vary greatly in the services they offer, fees they charge, and overall trading experience. Some online brokers cater to high-volume traders, while others aim to provide a more user-friendly experience for those new to trading. Several factors should be considered while choosing the online broker. First, consider the fees charged for each trade. While some brokers offer commission-free trades, it's a good idea to understand the complete fee structure before opening an account. Next, examine the trading tools and educational resources the brokerage provides. Sophisticated analytical tools may be important for advanced traders, while new traders may place more value on educational resources and customer service. Remember to also consider the broker's reputation, financial stability, and regulatory standing. A responsible broker will have ample information available on their website about the company's business practices. Opening a trading account. Once you have researched and selected a broker, the next step is to open a trading account. The process will typically involve filling out an application online, providing personal information like your name, address, social security number, and other contact information. Then, you'll answer questions about your investment experience and risk tolerance. This information allows the broker to provide you with suitable investment recommendations. After completing the application, it's time to fund the account. Depending on the broker, this can be done through a bank transfer, check, or even a rollover from a retirement account. Once the account is funded, you'll be able to choose the securities you want to invest in. Most brokers offer a broad range of investment choices, including stocks, bonds, mutual funds, and more. However, before placing trades, you should spend some time familiarizing yourself with the trading platform. Understand how to place trades, and learn how you can use the tools available to aid in your investment decisions. In conclusion, setting up a trading account involves selecting a reliable online stockbroker, filling out an online application, funding the account, and learning how to use the platform. Make sure to take your time during the selection process to ensure you choose a broker that suits your trading style and needs. This way, you're setting yourself up for a smoother, more successful trading voyage. Analyze the market. Use tools to study market trends, research companies. Analyzing the market is an essential component of any business strategy, whether you are a small business owner, a startup entrepreneur, or an established company looking to expand or launch a new product. It allows you to understand the dynamics of the market where you operate, identify opportunities and threats, understand your competitors, and make informed decisions about your business. Market analysis requires proper tools and techniques to study market trends and research companies. These tools range from primary research methods such as surveys and interviews to complex software solutions and algorithms. However, the ultimate purpose of all these tools is to provide valuable insights that can guide a company's strategy. One common tool is pestle analysis, which allows businesses to study the macro-environmental factors, political, economic, social, technological, environmental, and legal, that could impact their operations. This analysis helps identify how these factors could create opportunities or threats for the business. Another essential tool is Porter's 5 Forces, which helps assess the competitive environment within an industry. It analyzes competition intensity, the threat of new entrants, the power of suppliers and buyers, and the threat from substitute products. SWOT analysis is also a useful tool that helps businesses identify their strengths, weaknesses, opportunities, and threats. This model enables them to leverage strengths, improve weaknesses, exploit opportunities, and mitigate threats. Market research companies provide tools and services to analyze market trends. They use techniques like data mining and statistical analysis to understand customer purchasing habits, preferences, and future trends. It helps businesses know their customers' needs and wants, and what their competitors are offering. In addition to these, digital tools like Google Trends help to understand popular search queries across different regions and languages. Social media analytics tools give insights into customer behavior and preferences. Advanced techniques like machine learning and predictive analytics can help forecast future market trends and behaviors. However, it's essential not only to gather and analyze but also interpret the data correctly. Businesses should understand the context of the information and relate it to their specific industry and business goals. By doing so, they can make strategic decisions that drive their competitiveness and growth. In conclusion, market analysis is a complex task involving various tools and techniques, but it is crucial for a business's success. By analyzing the market, businesses can gain insights that allow them to position themselves effectively and stay ahead of their competitors. Develop a trading strategy. Create a strategy based on your risk tolerance and investment goals. Developing a trading strategy that suits your risk tolerance and investment goals can be a strategic approach to trading, be it in forex, stock, commodities, or even cryptocurrency markets. Having a distinct plan can keep you protected from making impulsive decisions driven by emotions and helps produce a more reliable performance over time. Define your investment goals. Before developing your trading strategy, it is crucial to identify your investment goals. Are you looking for quick, short-term gains, or are you investing for the long term? Your goals could also be depending on whether you aim to grow your wealth, to save for retirement, or to earn a steady income. Determine your risk tolerance. Every investment carries some risk. Understanding your risk tolerance, the amount you are willing to risk in pursuit of your investment goals, is critical. Your individual risk tolerance might be affected by various factors such as your financial situation, investment goals, and personal disposition. Choose your investment. Depending on your investment goals and risk tolerance, select the assets or financial instruments that align with your strategy. You might want to invest in shares, bonds, mutual funds, or forex, among others. Each of these instruments has a different risk-reward profile and requires a distinct approach. Develop a trading strategy. Two popular types of trading strategies are fundamental analysis and technical analysis. Fundamental analysis involves evaluating the economic and financial factors influencing the value of a security, while technical analysis focuses on statistical trends collected from trading activity, such as price movement and volume. Test your strategy. Before you start trading, test your strategy on past market data to see how it would have performed. This process, known as backtesting, can help identify potential flaws in your strategy. Implement your strategy. Start trading according to your strategy and keep a close eye on your performance. Be prepared to make adjustments as necessary. Continuous reviewing and adjusting. Market situations can change rapidly, and so, frequent reviewing and adjusting of your strategy components are crucial to cope up with these changes. Remember, no strategy guarantees a 100% win. Losses are intrinsic to trading. A robust trading strategy is one that yields more gains than losses over time, aligns with your investment goals, and suits your risk tolerance. Additionally, patience, discipline, and the willingness to learn from mistakes and successes are key to becoming a successful trader. Be ready for continuous education, as financial markets evolve constantly with changing economic environments. Start small. Begin with a small amount of money to limit potential losses. Investing can be a daunting venture, especially for beginners who are mired in the fear of losing their hard-earned money. However, it's not as scary as it is popularly portrayed if approached thoughtfully. A smart and less risky way to go about it is to start small. Starting with a small amount of money is a great way to gain experience in the terrain without putting too much at risk. This way, even if you suffer losses, they will not have a significant impact on your overall finances since it's a small sum that's invested. The principle of starting small also encourages you to learn to grow your investment, understand the market dynamics, and hone your investment strategies. This approach fosters prudence and patience, steering you clear from hasty decisions driven by the buzz in the market. When you start small, you can afford to make mistakes and learn from them without enduring heavy financial loss. Just like learning any new skill, practice makes perfect. The harder falls are better cushioned when the height is lesser. Another advantage is the gradual understanding and handling of the emotional roller coaster that comes with investing. Starting your investment journey with modest sums makes it easier for you to stay calm during market downturns, adapt to potential losses, and gain emotional resilience, all without hindering your financial stability drastically. Furthermore, starting small makes it easier to invest. Many people use the lack of ample funds as an excuse for not investing. But most investment platforms these days allow you to start investing with as little money as you have, carving opportunities for everyone to grow their wealth. In summary, starting small is a prudent and practical approach to investing. It allows for beginners to comfortably familiarize themselves with market trends, create a financial cushion, and learn from their mistakes. It's always better to start small and learn the ropes than to stay out of the investment game entirely. Diversify your portfolio. Invest in a range of stocks to spread risk. Building wealth and securing your financial future requires strategic planning and informed decision-making. One of the fundamental principles of investing is diversification, spreading your investments across different types of assets and sectors. Maintaining a diverse portfolio ensures that you're not putting all your eggs into one basket, thereby minimizing the risk of financial loss. Investing in a range of stocks is a good way to diversify your portfolio. Stocks are shares of ownership in a company, and they are an excellent investment vehicle for both short-term and long-term financial goals. However, investing in one stock creates a high-risk scenario. If that particular company suffers a setback or falls into financial trouble, your investment would be hit hard. To spread the risk, it is advisable to invest in multiple stocks across different sectors. For example, you could invest in the technology sector, healthcare, energy, consumer goods, financial services, and so forth. Each sector responds differently to economic changes. When one sector is down, another might be up. Furthermore, stocks vary in terms of company size, small, mid, and large cap, location, domestic or international, and category, growth, value, or income stocks. Each type of stocks offers varying levels of risk and return. Therefore, A diversified portfolio consisting of diverse stocks can potentially optimize your returns while reducing the level of risk. Also important is to periodically rebalance your portfolio. Market fluctuations may upset your original asset allocation, causing some investments to be overrepresented while others underrepresented. Rebalancing enables you to maintain your desired level of risk by selling off outperforming assets and buying more of the underperforming ones. In conclusion, diversifying your investment portfolio by investing in a range of stocks can provide an effective shield against the volatility of financial markets. Diversification, coupled with careful planning and regular review, can help to stabilize your portfolio, achieve a respectable rate of return, and pave the way toward financial security. However, all investment decisions should be guided by your personal risk tolerance, goals, timeframe, and understanding of the market. Consulting with a financial advisor can further aid in crafting a diversified portfolio that suits your individual needs. Continually monitor the market. Keep track of market trends and news events affecting stocks. Monitoring the market incessantly is crucial for any individual or organization that wishes to invest or already invests in stocks. It's the process of consistently analyzing and tracking financial market trends, financial news, politics, economic indicators, market indexes, and other relevant factors influencing stocks, to make informed investment decisions. Keeping track of market trends helps to understand the direction in which markets are moving. For instance, during an upward trending or bullish market, investing in stocks may yield higher returns, while during a downward trending or bearish market, it might be riskier to invest. Different sectors also have different trends that can be studied to diversify one's stock portfolio adequately. Monitoring the news events affecting stocks is equally essential. Major news events, either international or domestic, can have a significant impact on stock prices. For example, political instability, changes in government policies, sudden economic changes, natural disasters, or significant corporate events like mergers and acquisitions can cause stock prices to fluctuate drastically. Thus, keeping an eye on such news events provides an investor with valuable insights to modify their investment strategy accordingly. Furthermore, apart from just monitoring, it is necessary to comprehend how these various factors tie together to impact the financial markets. For instance, a change in the government's monetary policy might influence the inflation rate, which in turn could affect the industrial sector trends, thereby affecting the stocks of companies within that sector. In conclusion, continually monitoring the market allows investors to forecast potential opportunities or threats, thereby helping them take timely investment decisions. This information can be gained through various means such as financial news outlets, economic reports, corporate announcements, market analysis tools, and more. However, it is also important to note that while monitoring the market provides useful insights, investment decisions should also be based on thorough personal financial analysis and risk assessment. It's advisable to seek aid from financial advisors or use automated investment tools. In the end, the ultimate goal is to maximize returns and minimize risks. Buy and sell stocks. Implement your trading strategy, buying and selling stocks via your trading account. Buying and selling stocks mark crucial aspects of investment strategy executed through your trading account. With these two actions, you can profit from the fluctuating prices of stocks and build wealth over time. However, like any business or economic activity, these concepts are embedded with strategies and understanding. Understanding when to buy stocks. Before buying any stocks, it's important to implement a trading strategy. This involves understanding the company's operation, market position, competition, and financial health. Also, it's best to buy stocks when they are undervalued or priced below their intrinsic value. This can be determined using various valuation models such as discounted cash flow analysis, price-earnings ratio, or comparing it to the sector average. Importance of diversification. A critical part of any strategy includes diversifying your portfolio, which means buying stocks from different sectors to spread risk. If one sector underperforms, gains from other sectors can offset losses. Timing your sell. An investor should sell a stock when it reaches its intrinsic value or if the fundamentals of the company changes negatively. The principle of buy low, sell high should prevail while making these decisions, but emotional decisions may hamper the outcome. Thus, it's important to make these decisions based on objective analysis. Automated trading strategy. With the advent of robo-advisors and automated trading bots, trading strategies can now be executed automatically based on predefined rules. These can help in eliminating human emotions out of decision-making, especially in a volatile market. Frequent review. Regular review and adjustment of buying and selling strategies are important as per market conditions and individual financial goals. Regular analysis of a company's quarterly earnings reports, economic indicators, and market trends helps to identify if any changes are needed in your strategy. RSI, Relative Strength Indicator, SMA, Simple Moving Average, or Bollinger Bands are some of the technical analysis indicators that are used by traders to determine the right time to buy or sell a stock. The implementation of these technical indicators can be helpful in forming a trading strategy. Using stop-loss orders. One of the best strategies for investors is to use stop-loss orders. This allows you to limit your loss on a position by setting a predetermined selling price. When the stock drops to this price, it is automatically sold. Consider tax implications. Last but not least, always consider the tax implications of your buy and sell decisions. Investors should try to hold stocks for more than a year, as the gains will be taxed at the lower long-term capital gains rate. All these functions take place via your trading account. A trading account gives you access to the stock market and allows you to buy, sell shares. The account connects you with a brokerage who can execute trades on your behalf. Investors are advised to choose a reputable brokerage and do a full assessment of any fees involved. It's also important to remember to only invest money that you're willing and able to lose. While the stock market has historically provided significant returns, its inherent riskiness remains significant. Review and adjust strategy. Continually review your strategy and make adjustments as needed. Review and adjust strategy is a continuous process that an organization or individual undertakes to ensure business growth. This concept is crucial because business environments are constantly evolving. Factors like changes in technology, market trends, or even political and economic shifts could impact an organization's strategic implementations. Therefore, regular review and adjustment of strategy is vital to business survival and success. The first step for reviewing strategy is tracking performance. This can be done by evaluating key performance indicators, KPIs, and comparing actual results with expected results. Are you reaching your set targets? If not, it's essential to determine the cause and take appropriate steps to rectify the problem. Consider conducting a SWOT analysis, strengths, weaknesses, opportunities, threats, both at the beginning and midway of your strategic implementation. This can help to identify any internal or external changes that might affect your business. Strengths and weaknesses are internal factors, while opportunities and threats are external. Understanding where you stand concerning these factors can assist in realigning your strategy for better success. Another essential part of the review process is gaining feedback either from employees, stakeholders, or customers, depending on the strategy implemented. Their insights can reveal potential areas of improvement that were initially overlooked in the strategy planning. Moreover, regularly keep an eye on the financial facet of the strategy. Is it proving to be financially feasible? Are the costs exceeding the budget? If yes, look for areas where the costs can be minimized or adjust the budget accordingly. Remember, adjusting the strategy doesn't always mean a complete overhaul. Sometimes, minor tweaks here and there could be enough to get you back on track. However, it's important to keep an objective view and be ready to make tough decisions if required. Lastly, adopting a flexible mindset is the key to adjusting strategies. The ability to learn, unlearn, and relearn strategies as per changing circumstances could be the deciding factor in your business success or failure. In essence, the review and adjustment of strategy is not a one-time task, but an ongoing process. It's all about fostering a culture of continuous learning, adapting, and improving to ensure the long-term sustainability of the organization. Reinvest profits. Use any profits you make to invest in more stocks. Reinvesting profits is an investing technique that encounters using the returns or profits from one investment to fund further investments. This concept refers to taking the dividends, capital gains, or interest earnings from an investment, and investing those profits back into the market. This is a powerful tool for investors as it allows their investments to compound over time. When it comes to stock investing, reinvesting the profits means purchasing more shares with the earnings gained from the initial investment. For instance, if you invest in a stock and it goes up by 10%, you could sell the stock, take the cash, and reinvest it to buy more shares. Several reasons support why reinvesting profits is beneficial. Among them, the most important one is the power of compounding returns. Through reinvesting, you buy more stocks which can potentially earn more profits, which in turn can be reinvested. Over time, this multiplying effect can result in exponential growth of your initial investment. Another reason includes purchasing additional stocks without having to increase out-of-pocket expenses. It gives you an opportunity to grow your portfolio without having to contribute more of your own capital. Investors can also take advantage of dollar cost averaging through reinvesting profits. This strategy involves making regular investment purchases, regardless of the share price. When prices are low, your reinvested dividends will buy more shares, and when prices are high, they will buy fewer. Over time, this can average out the cost of your investments. Reinvesting profits can also lead toward creating a diversified portfolio with a more extensive group of stocks acquired over time. A diversified portfolio can result in reduced risk as one wouldn't solely depend on one or two investments. However, keep in mind, while it's a powerful tool for growing wealth, there are times when it is not the best option. It heavily depends on individual investment goals, personal finance situation, and market conditions. For instance, if a particular stock is consistently underperforming, it may not be wise to reinvest in the same. Moreover, at times, investors might need immediate cash flow instead of future growth. In such cases, taking out profits could be more beneficial. Investing should always be carried out strategically, understanding the potential risks and benefits associated with whatever decision you make. In such cases, it is often advisable to seek professional financial advice to make the most out of your investments. Understand tax implications. Keep track of your earnings and understand your tax obligations. The freelance economy, also known as the gig economy, has experienced significant growth in recent years with an increasing number of individuals opting for flexible, project-based work. However, working as an independent contractor brings its unique set of challenges, such as understanding and managing tax obligations. Firstly, keeping track of your earnings is crucial. As a freelancer, you might have multiple income sources, and it becomes even more essential to keep a detailed record of all your income, invoices, and expenses. You would need this record when preparing your tax returns or in case of an IRS audit. Also, it's crucial to understand that independent contractors and employees do not share the same tax structures. Unlike an employee, a freelance worker must be responsible for their Social Security and Medicare taxes, traditionally paid in part by employers. This is often referred to as the self-employment tax. Moreover, while employers withhold income tax for their employees, freelancers are obligated to estimate and set aside their potential tax liability. Calculating this can be difficult because the appropriate percentage to set aside varies depending on your total income, tax deductions, tax credits, and filing status. An understanding of allowable deductions can also lower your tax liability significantly. Typical deductions for freelancers might include job-related expenses such as a computer or other equipment needed for work, home office expenses, travel costs, professional development costs, and health insurance premiums. Freelancers may also need to pay estimated taxes quarterly, not just annually, to avoid potential penalties. This means staying on top of your income and expenses in real time and understanding your tax obligations at any point in time. Fortunately, there are numerous resources, including tax software and professionals specializing in freelancers' tax implications, to guide individuals through this process. Hence, it becomes important to comprehend these tax implications well in advance, as failing to address these can lead to penalization and an added financial burden. By staying organized, seeking professional help when needed, and using available resources, freelancers can effectively meet their tax obligations without losing focus on their work. Keep learning. Constantly update your knowledge about the market and various strategies. In a rapidly evolving world, every sector and industry is consistently changing. This especially holds true for the market scenario. What may be profitable today may not be so tomorrow. As such, maintaining a static, unchanging strategy can be detrimental. To operate successfully in any field, it's essential to keep learning, updating your knowledge, and refining your strategies according to the current market conditions. Firstly, understanding market trends is critical. These trends provide vital information about consumer behavior, industry shifts, and changes in various economic factors that influence the market. Keeping a keen eye on these trends will help you adapt your strategies in line with current demands and requirements. Moreover, it's helpful in predicting future trends, letting you stay ahead of the competition. Secondly, markets are also significantly affected by technological advancements. For instance, the rise in AI and machine learning has brought significant changes in data analysis, prediction models, and automated trading. By constantly updating your knowledge in these areas, you can leverage new technologies to your advantage. Aside from harnessing technological shifts, staying informed about policy changes, global events, political scenarios, and the socio-economic environment is equally important. These factors directly or indirectly create ripples in the market, and being aware can help you respond promptly and adequately. Lastly, the continual learning approach extends to financial instruments and strategies too. As new financial products are introduced and old ones are modified, learning about them helps you widen your portfolio and diversify your investments. In conclusion, adopting a mindset of continuous learning is a prerequisite in a dynamic market environment. It's essential to stay informed about changes in market trends, leverage technological advancements, understand global events' impact on the market, and always seek to learn about novel investing strategies and instruments. This approach can not only help you survive but thrive in the market in the long run. Be patient and persistent. Stock market profits typically come over the long term. Investing in the stock market is often presented as a quick route to immense wealth and financial independence. However, this isn't entirely true. Yes, investing in the stocks can indeed lead to significant profits, but these usually accumulate over a long period rather than overnight. Patience is an essential virtue in the stock market. It takes time for investments to mature and yield returns. It may take months, sometimes years. Patience helps you to weather the fluctuations in the market and enables you to hold onto your stocks when everyone else is panic selling. It allows you to wait for the long-term trend to reveal itself and for your investment thesis to play out. Understanding and accepting the time frame of investing is crucial to maintaining patience. Likewise, persistence plays a vital role in stock market investment. You need to keep investing wisely and regularly to experience substantial gains. Sometimes, investments can go south, and you may experience significant losses. However, staying persistent and not being fazed by temporary setbacks is an element of successful investing. Investing is not about making money quickly. Instead, it's about continually investing, learning from mistakes, and improving your strategies. Remember, the stock market isn't about overnight success. It's more akin to a marathon than a sprint. It's about keeping consistent with your investment strategy and resisting the temptation to deviate from your long-term goals. Moreover, patience and persistence in investing also imply discipline. It means sticking to your financial plan even when the market is not performing well, or when exciting, albeit risky, investments present themselves. It's worth noting that successful investors like Warren Buffett did not make their fortunes overnight but accumulated their wealth over a long period. To sum up, to profit significantly from the stock market, you need to show patience and persistence. Ride through the market lows, hold onto your high-performing stocks, keep investing regularly and wisely, and you're likely to see profits over the long term. Don't let short-term market volatility derail your long-term financial plan. Patience and persistence may not be the most exciting strategies, but they have proven to be the most successful ones over time. Use stop-loss orders. This helps to manage your risk by setting a limit on your potential losses. Stop-loss orders are instructions to any broker to buy or sell a stock or other financial instrument once it reaches a certain price point. Essentially, stop-loss orders automatically execute a trade once a stock reaches a certain price, thus saving investors from potential catastrophic losses. One of the most significant benefits of using stop-loss orders is that it ensures you will only lose a certain amount if a stock's price is plummeting. They can be incredibly useful in managing risk, particularly for those who are not continuously monitoring market prices. They provide investors with an exit strategy if the price of a stock drops suddenly or if the market hits a downturn. This provides investors with an insurance policy against significant financial loss. Another advantage of stop-loss orders is they eliminate the need for constant monitoring and decision-making. Investors can rest easy knowing that they won't lose more than a specified percentage or dollar amount, making them particularly attractive to part-time investors. However, it is important to mention that stop-loss orders are not foolproof. For instance, if a stock's price gaps down, the stock will be sold at the next available price, which may be lower than anticipated. Moreover, setting the stop-loss at incorrect levels due to lack of understanding or knowledge may lead to unwanted closures of positions. Also, they may not be beneficial for those who invest in volatile stocks or securities as these can often fluctuate in price. This could trigger your stop-loss order and result in the sale of your stock, even if the price increases once again shortly afterward. Therefore, it is advisable to set stop-loss points at a safe distance from prevailing market price in proportion to volatility to avoid such scenarios. Overall, Stop-loss orders are an essential tool for risk management for its capacity to limit potential losses. However, they should be utilized strategically considering various factors such as asset volatility, market trends, and investors' risk tolerance. Regularly review your portfolio. Keep a close watch on how your investments are doing and make necessary changes. Maintaining a well-balanced portfolio is key to achieving your financial goals. By regularly reviewing your investments, you can ensure that you're managing your risks, staying on track to meet your objectives, and making the most out of your investment opportunities. Risk management. Regularly reviewing your portfolio helps you to manage your exposure to risk. Investments can change over time. A stock that was considered low risk when you bought it may have become high risk. By reviewing your portfolio, you can assess these shifts and mitigate potential losses. Achieving objectives. If you've set specific financial goals, regular evaluations will enable you to measure your progress toward these objectives and make necessary adjustments. For instance, if one of your objectives is to purchase a home in 5 years and the investments dedicated to this goal aren't performing as expected, a review would present the opportunity to realign your strategy. Asset allocation. The performance of your investments might change your initial asset allocation. For instance, suppose that you have 50% of your portfolio in stocks and 50% in bonds. If your stocks do well, you might end up with a 70-30 allocation. In this case, you may decide to sell some stocks and buy bonds to get back to your desired allocation. Regular reviews help you to maintain your asset allocation strategy and balance your portfolio. Tax implications. Regular review allows you to be more strategic in managing taxes on your investments. You can minimize your tax burden by timing the sale of investments, considering the tax implications of holding certain assets, and taking advantage of tax-efficient investment options. Detecting market changes. Market dynamics can profoundly affect your investments. By constantly monitoring your portfolio, you can identify new investment opportunities or threats, respond to market shifts, and adjust your holdings accordingly. Learning opportunity. Constant evaluation of your portfolio can make you a better investor. You can understand the impact of your investment decisions, learn more about market phenomena, and enhance your finance management skills. Creating a schedule to regularly review your portfolio can be beneficial. Whether it is monthly, quarterly, or semi-annually, the important thing is that it should fit your needs and you remain consistent. Consider seeking advice from a financial advisor for an expert perspective, especially if you're unsure about making changes to your portfolio. Remember, portfolio review isn't just about making changes, it is also about learning and understanding the process and progress of your investments. Some investments take time to mature, and unnecessary tinkering may inhibit growth. Hence, while change is crucial, it needs to be a well-calculated decision guided by careful analysis rather than impulsive actions based on market rumors or temporary fluctuations. That's a wrap on today's video, everyone. But guess what? We've got plenty more exciting content coming your way. You don't want to miss out. If you've enjoyed our time together today, please consider fueling our passion to bring more of this content by hitting the subscribe button. By doing so, you'll be the first to know when we drop another video like this. Go further by smashing that like button, and don't forget to leave us a comment. We love hearing your thoughts and ideas. But wait, before you go, remember to click on the bell icon too, that way you'll always get notified whenever we release a new video. Finally, it doesn't end here. If you can't get enough of our content, why not dive right into our treasure trove of previous videos? Just click here, insert link, and you'll be routed straight to our rich library of content. Thanks again for your time today. We hope to see you again soon. Until next time, stay awesome.